Well, the SALT conference is underway in Las Vegas as trade tensions weigh on the minds of investors. Yahoo Finance's Scott Gamm is live from Las Vegas with Troy Gayeski, Co-Chief Investment Officer at Skybridge. Scott?
All right, Shauna, thank you so much. Troy, great to have you here. Thanks for having us at SALT.
Yeah, great to be here. Thanks for coming.
Let's start off with your take on the markets, because
Yes.
this week we've got trade worries front and center. It seems like investors are reacting kind of minute by minute to anything that President Trump says about trade. How do you view the situation?
Yeah, a lot of people react minute by minute to what Trump says, right? Yeah, it's very interesting. So markets had priced in a much higher probability of a deal be completed. So coming into late last week, market expectations were roughly 80 to 90% of the deal would be completed. Obviously, it appeared, from what we know, that China walked back some of their commitments. And that doesn't sit well with the Trump administration, certainly guys like Lighthizer, who are much harder edged. And so, we're preparing for tariffs to be implemented. Trump is trying to dangle the potential for a deal, but it's really hard to reconcile these issues, right? Unless China is going to step back from intellectual property theft, reduce the subsidies for their state-owned enterprises, which have always been the thorny issues. The administration has been pretty consistent, whether you like it or not, that either we're going to get a good deal, in what in their minds is good for the American people, or there will be no deal and higher tariffs will be implemented.
In terms of the market impact, though, we hear a lot of folks say, oh, trade tariffs are bad for stocks. But, we've been dealing with the trade war threat for over a year now,
Yes.
and stocks are flirting with record highs.
Yeah, so I think the big picture of what this is that the pro-growth policies of the Trump administration, what we refer to as good Trump, are outweighing the counter-growth policies, i.e. tariffs, which we refer to as bad Trump. And what we mean by that is if you look at the power of tax reform, creating more incentives to invest in the U.S., lowering the corporate tax rate, having accelerated depreciation on property, plant, and equipment investments, very powerful stimulus. It's had a big impact on CapEx and business fixed investment spending. When you look at the deregulatory agenda, again, particularly in financial services, but also energy, that's led to better growth. And against that, you will have some friction. You will have slightly lower growth than you would otherwise because of tariff implementations. But by no means is implementing tariffs, additional tariffs on China, enough to drive the economy into recession. I mean, we'll probably shave 20 to 30 basis points off growth than would be otherwise. There'll be some disruption for corporate America. We'll have 1 to 3% lower earnings growth the next 12 months, but the U.S. economy will do just fine.
So with that backdrop, should you be putting new money to work right now?
Yeah, so we think if the tariffs are implemented, the extra $250 billion of goods at 25%, there probably will be a little more short-term mark-to-market weakness. But remember the path. We had a big correction late last year driven by the Fed. The Fed pulled a 540, so they spun around in a circle and pointed the opposite direction. We had a huge rebound. We got it back up to 16.5 to 17 times forward earnings. So markets would naturally be prone to correction. This is an excuse to sell. We think over the next week or two, it could be a good opportunity to put capital to work.
All right, Troy, we're out of time. We'll have to leave it there, but thank you very much for having me.
Great to be here. Thank you so much.
Thank you. All right, Shauna, back to you.
All right, Scott and Troy, great stuff. Thanks so much.